you can type in the window box. Am I audible, friends? Okay, that's great. Okay, that's great. People who are new to this GUI, let me tell you that you have a chat box in your system. So, okay. Is that fine, Nalini? Is it better now? Is it better now? Guys, tell me the voice quality. Is it fine? Should I increase the volume, decrease the volume? Okay, okay. Nalini, I think you need to increase the volume at your system. I think people are finding it okay. Okay, great. Okay, so let us start now. Hi friends, I'm Anil and I'm going to take your session on fixed income securities. So in this session, as it is already conveyed to you, we'll talk about the basics of bond valuation. So we will see a few key characteristics of bonds, and we will also try to model the relationships between the price of the bond and various parameters. So starting from the very basics, let us talk about valuation in general. So if I talk about valuation, so any kind of valuation, the general philosophy is that there are always three components. Okay, so if you talk about any kind of valuation, there are always three components. So the first one is the cash. So if you are trying to see the valuation of any product, the most important thing is cash. Okay, so this general principle will hold for each and every product. Okay, so be it equity valuation, anything. Okay. Second component is the expectation of the investors. So when I say expectation, it can have different meanings. Expectation of the investor. And the third important thing is time or time frame. So as I told you, cash is the cash that an investor is getting. Expectation is what is the expectation of the investor, and the time is at what time frame they are getting this cash. So this cash and this time is interrelated. So when I say time, so the gist is that $100 today is better than $100 tomorrow. Okay, so for every cash or any valuation, there is always a time frame associated. So these are only three components, and then we can define these three components depending on what kind of valuation we are looking at. Okay. So in the expectation part, I mean to say that for two investors, a same product is not exactly similar. Okay. So let me talk about say a particular company. So say a particular investor wants to invest in the stock of a particular company. His expectation would be very different from a person who is acquiring that particular company. Getting my point? So depending on what expectation is, your valuation numbers would change. Okay. So expectation numbers depends on a particular investor. So here, what is the cash from? What is the cash from the investment? Okay. So that is from the investment. What is the cash? So that is not more or less same, but based on the expectation, the valuation numbers would change. Okay. So as a simple example for any discounted cash flow problem, we will say I have a timeline here. Okay. So suppose you invest $100 today, okay, in a bank, and the interest rate by the bank is 10%. So if I ask you what is the amount that you will receive after 1 year, so you will say $110 because the interest rate is 10%. So how do you calculate that? That is 100 into 1 plus 10%, correct? So that is the final amount that you are going to receive after 1 year. And similarly, if I say what is the total amount that you're going to receive after 2 years if you don't take out the interest part, and that would be 100 into 1 plus 10% raised to power 2, correct? So this is very equivalent to this kind of problem, that if I'm getting $110 after say 1 year and the interest rate in the market is say 10%, what amount should I pay today? Okay, so the question is, say if I ask you that you give me $110 tomorrow, okay, what amount should I pay you today, right? So it's exactly the similar kind of relationship. So here we are calculating the present value of the future cash flows. Here we are calculating the future value of the cash flows. All right. So here the amount, why these amounts are different? These amounts are different because of this time frame. Okay. And what was the cash involved? Cash involved was $100. And what was the expectation here? The expectation of the investor is 10%. Okay. So here, for any kind of valuation, there are always only 3 components involved. One is cash, second one is what are the expectations, and the third is what is the time frame. All right. Now, same logic we are going to apply in the bond valuation. So simple bond valuation. So here in simple bond valuation, again we will have 3 components. What are the cash flows from the bond? What is the expectation of the investor? And at what is the time frame involved? Okay. So first of all, what a bond is. If I have to say what is a bond, let me take a simple example. Suppose I have a company A. Okay. So this company needs some $100 today. Okay. So they need this money. So what they will say, they will float a security, or say they will float a simple paper in which they will say that investors, you pay me $100. Okay, so this is group of investors. You pay me $100. Okay, and after T period, I will repay this $100 back to you. Okay, so after T periods, I will repay this $100 back to you. But also I will pay some interest rate on that, and that interest rate is say C% on this $100. Okay, so say I pay C% on this $100 at every year. So if say T is 5 years, okay, so they will say at every year I will pay C% on this $100. So if the C is 10%, so this company A would pay $10 every year to these investors. Okay, and also they will repay all the principal amount at the after 5 years. So this 5 year is called as maturity of the bond or the maturity of the paper. So this is maturity, and this C is called as coupon. So this interest rate that company A will pay to these investors is called as coupon payment. Okay, so coupon payment is always in percentage, or say any interest rate quoted would always be in percentage and in the analyzed form. So this is 10% analyzed. Okay, so this 10% would be calculated on the basis of this $100. This $100 is now called as the notional amount, denoted by N. Okay, and what is the time to maturity? Time to maturity is 5 years. So if I have to see what are the cash flows involved, so from the company's perspective, cash flows would be at t equal to 0. Okay, cash flows would be $100. Okay, cash flows would be $100, and here the interest rate would be 10% on this $100 would be repaid to the investors, so that would be minus $10. Then at t equal to again minus $10, minus $10, minus $10, and at the maturity it would be minus $10 as the interest payment and minus $100, which is minus $110, right? So these would be the cash flows involved. Now the thing is, I said that depending on what is the expectation of the investors, the price would be calculated. So here, ideally, what equation should hold true here? The equation that should hold true here is that if I calculate the present value of all these future cash flows that the company is going to pay to the investor, if I calculate all the present value, that present value should sum equal to $100, correct? Right. So here I need to calculate what is the expectation of the market. So company may want to get $100, but depending on the expectation of different investors, investors may or may not be willing to pay $100 to the company. Okay, so here what amount the company would get in the beginning, that is the price of the bond, okay, or the present value of all the future cash flows. So that may or may not be $100. Now here, since I'm calculating this C percent on 10%, okay, so here the C percent is not calculated on the price of the bond, but a notional amount of $100. So $100 would be the notional amount, that is some imaginary number, $100. Okay, on the basis of those $100, you have to pay, company has to pay 10% to the investors. Okay, and the same amount, this same notional amount, they have to repay back at the maturity of the bond. Okay, so this $100 is the notional amount. Okay, or it is also called as the face value of the bond. Now here, what amount this company would get is not exactly $100, but it may be any number depending on what is the expectation of the investor. So if that expectation is 10%, then company would get $100. If the expectation is something different, then this price or this present value of all the future cash flows may or may not be equal to the face value or the notional amount, right? So what is this expectation here? This expectation is also called as yield to maturity. So these are the jargons used in the bond valuation process. So these are the yield to maturity. Okay. So now in our Excel, we need to see how different parameters are behaving and how to calculate the cash flows from the bond, and then how to calculate the present value of the bond. Okay, so if the cash flow is this, then what should be the price of the bond? So it is simple, discounted cash flow problem. All right. So before actually moving to that part, let me insert a new slide, and let me try to explain the equation in detail. So here we have seen, so here we have seen this timeline. So we need to understand this timeline. So at t equal to 0, we have some cash flow. Now this is 1 year, this is 2 year, this is 3 year, 4 year, and so on. Okay, and this is the maturity t. Now here we have the coupon payments, which is C% into the notional amount. So C is the C percent, so this is in percentage, N is in dollars. Similarly here, the cash flow that the company need to pay is C into N. Similarly here, C into N, so on, C into N. And at the maturity, we have C into N plus N, because that is the notional amount. So if you remember, this was $10 and this notional amount was $100. So if I calculate the present value of all these future cash flows, what is the equation? The equation would be C into N upon 1 plus, what is the discount rate? That discount rate. So I call that as yield to maturity, right? This is for 1 year, the present value of the first cash flows. Then the present value of the second cash flow, Cn into 1 plus YTM square, so on. And at the maturity, I will have Cn plus N upon 1 plus YTM raised to power t. That is the maturity, right? So present value of all these future cash flows would be what? That would be equal to the price of the bond, right? Correct? So that would be the price of the bond. So if I have to combine this, I'll say summation of Cn upon 1 plus YTM raised to power t, where t varies from 1 to capital T, that is the maturity, plus the cash flow at the maturity. Now this is the summation of the present value of all the interest payments, plus now I will have the present value of the notional amount that the company will pay at the maturity. So 1 plus YTM raised to power t. So this is nothing but the price of the bond. Correct? Now here let us try to understand from the equation that the C is the coupon payment, YTM is what? YTM is the yield to maturity, or the discount rate, or the expectation of the investor. Now depending on the relationship between C and YTM, we may get a price which is either higher than $100 or it's lower than $100. Correct? So if the price is greater than $100, where $100 is what? Notional amount. If price is greater than $100, this implies that C would be greater than YTM. Okay, we'll see that in detail. But try to understand this. If P, so C is the numerator, YTM is the denominator. So if price is greater than the notional amount, it means that coupon percent has to be greater than the yield to maturity. And similarly, if P is less than the notional amount, say the price is less than $100, this implies that C would be less than YTM, or we can say it vice versa. So if the coupon payment is less than the yield to maturity, if coupon payment is less than what investor is expecting, then the price would be lower than the notional amount. And if the coupon payment is exactly equal to the YTM, then whatever interest rate our investor is getting, exactly same number is the expectation of the investor, right? So here you need to remember this YTM is nothing but the expectation. So this is the expectation of the investor. This C is what he is actually getting. So if his expectation matches with whatever he is getting, then the price would be exactly equal to the notional amount, right? Now, if the price is greater than notional amount, we call this as premium bonds. Okay, this is called as premium bonds. And if price is less than the notional amount, these are called as discount bonds. And if the price is exactly equal to the notional amount, we call that as par bonds. All right. Now, keeping this equation in mind, let us move to an Excel workbook, and now we will try to see what are the different relationships of price with different parameters. Okay. So I hope you already got this Excel workbook with you. So if not, I will send you that. Okay, don't worry. So here, if you see, this is the complete bond valuation process. So here I have assumed a notional amount of $100, coupon is 10%, and the tenure of the bond is again 10%. Okay, and say the interest rate or the yield to maturity for next 10 years is same, which is 6% only. Okay, so this is the assumption. So here I would not go in the very detail of this, that what this interest rate would be. So actually these interest rates can be changed. Okay, so we'll see in the later part of the sessions. But in this session, we'll assume this yield to maturity is same, which is 6%. Okay, and the coupon is 10%, and the tenure is 10 years. So with these assumptions, I want to find what is the price of the bond. And then later on, I want to find what is the relationship of these parameters on the price of the bond. Okay. So before I move to the next part, any doubt in this part? So I would like to look at the chat window. People have raised a few doubts. Okay, so give me some time to read it, and I will explain that. So now, if you have any doubt, you can type it at in the chat box. Okay, don't worry, guys. Even if you don't have the Excel workbooks, we'll send it after the session. Okay, don't worry. So you can just look at this Excel workbooks, and I'll send that Excel workbook to you. Okay. So because yield to maturity is on an average rate that an investor would expect from this bond. Okay, so if you are investing in a 10-year bond, what is the average interest rate that you would expect? Okay, so that yield to maturity. Bhaskar, that would be a qualitative question. Maybe towards the end of the session, I'll talk about it. So another question is, what comes first, price or yield to maturity? See, price is the dependent variable, YTM is the independent variable. So first you will have YTM, and from there you will calculate the price of the bond. Okay, but in reality, if a bond is traded in the market, you will find the price of the bond, and from there you will calculate the yield to maturity. Fine, Bhaskar. Yes, Mustafa, you will get a link for that. No problem. Gajendra, we will come to it. Good question. So Gajendra is saying, if C is less than YTM, then why would people buy this bond itself? See, here in this equation, if you see, so here people are always getting, so if this relationship holds true, so if the relationship holds true, people are, so here people are investors. Okay, so investors are going to receive this in cash flow in the future, and what they need to pay today is this P. Okay, so it does not matter whether C is greater than yield to maturity or not, because even if C is less than yield to maturity, today they have to pay less, right? So the important thing to note is that on an average, whatever this C and YTM would be, they would always get the implied interest rate on that. That is yield to maturity. Whatever return, that's yield to maturity. So depending on the value of C and YTM, your price would always change. So suppose you have two scenarios in which one in the first scenario you have C equal to YTM. Okay, so price $100. In the next scenario, you have C less than YTM, so say price is $20, right? Or getting the C, but initially you are also paying low. So if this equation holds true, you will always get the implied interest rate, that is the yield to maturity. Okay, so no matter what is the relationship between C and YTM, the interest rate or the implied interest rate that you are going to receive is always YTM. Does that answer your question, Rajendra? Okay, great. Is it better then? Is it better now, guys? Okay, okay. Is it fine now? Prashant, is it okay now? Okay, okay, give me a second. So here the notional amount is $100, coupon is 10%, tenure of the bond is 10 years, and the implied interest rate or the yield to maturity is assumed as 6%. Okay. Now, since the coupon, this C percent is 10%, what is the dollar amount that the investors are going to receive each year? That would be calculated on the notional amount, 10% into the $100, right? That would be $10. Now, what I want to do here is I want to find the discount rate from this yield to maturity. So discount rate here would be 6%, and based on 6%, what is the implied discount factor? Okay. In E0, if you are getting a cash flow at T equal to 0, what is the discount factor? That would be 1. At E1, what is the discount factor? If the discount rate is 6%, that would be calculated as 1 upon 1 plus this rate raised to power the number of years. Okay. So if you have a cash flow, say Cn, so how they calculate the present value? The present value was Cn upon 1 plus r raised to power time, right? So here 1 upon 1 plus the rate raised to power t, that is the number of years, would give you the corresponding discount rate. It is 0.94. This 0.94 means that a dollar today, dollar after 1 year would be equivalent to $0.94 after, here. So here's the meaning of this, equal to 1. Okay, so this is t equal to 1. So if I get a 1 at t equal to 1, that would be equivalent to $0.94 today. So that's the thing of this 0.94, right? And similarly, I would calculate what is the discount factor for year 2. Means that if I receive $1 after 2 years, what's equivalent amount today? So if you give me $1 after 2 years, what is the value today? And if you are ready to give me $1 after 2 years, what amount should I pay you today? So that would be again 1 upon 1 plus the rate, which is expectation, raised to power the following year. So that similarly, I calculate the discount factor for the years. Okay. So I've calculated the discount factor for all years. Now, what are the coupon payments? So coupon payments are $10 for each year, correct? So $10 for each year. Now, so tomorrow I want to build a model which is slightly flexible. So tomorrow, even if I change this 10 years to say 5 years, this model should work accordingly. So what I'll say, I'll get 10% whenever this year is less than equal to the time to maturity, correct? So I can write a if statement here, or I can simply say, so I can build a flag here. So if this year is less than equal to the tenure, okay, then give me this cash flow. Okay, so here till year 5, you will get this coupon payment, and from there onwards you will not get any cash flow. So what I'll do, so this true false are binary numbers, so true is equivalent to 1, false is equivalent to 0. So if I simply multiply this with true and false, I will get this relationship, correct? So here till year 5, I'm getting this coupon payment of $10, and from thereafter I'm getting 0, right? So now my model is slightly flexible. So even if I change it to 2 years, so it will automatically consider this for 2 years, right? And I know that the maturity, I would get the notional amount. So here again, I will first check that when I get this notional amount, so this year, whenever this year is equal to the tenure, you would get the notional amount. So here is saying a 2, you are getting a true, correct? So here you will get this notional amount. So if I multiply this with the notional amount, I will get that amount at the maturity, correct? Now this is the total cash flow, right? So for 2-year bond with 10% coupon rate and the notional amount of 100, these are the cash flows that the investor is going to receive, correct? Now even if I change this to say 5 years, these are the cash flows that the investor is going to receive, right? Now what is the total cash flow? The total cash flow is sum of these two cash flows. Now this is the total cash flow that the investor is going to receive for this tenure, that is 5 years. Now if I multiply these cash flows with the discount factor, okay, if I calculate the present value of these cash flows, that would be the amount that the investor should be ready to pay today. Okay, so if I simply multiply this with the cash flows, so this is the amount that the investor should ready to pay, so $117. So if I take this sum, of these cash flows, this is the price of the bond, or this is the price that the investor should pay today to get hold of all these future cash flows if his expectation is 6%. Okay, so this is nothing but the price of the bond. So it boils down to a simple discounted cash flow problem. So here the first important thing is what is the cash you are getting. The second important thing is what is the expectation of the investor. And the third important thing is what is the time frame. So depending on when you are getting these cash flows, your value would change. Correct? Now this is the basic price of a bond. Any question on this? Okay, Nityanan says, can you explain true, false again? Okay. See here, what I'm trying to do here is I'm trying to build a flag. So here I want to make my model slightly flexible. Okay. So here I want to say that till this maturity, that is 5 years, okay, till this maturity 5 years, I should get these coupon payments, and after that I should not get any of these coupon payments. And similarly, at the maturity I should get the notional amount, okay, and summation of the coupon payments and the face value would be the total cash flow to the investor. Now to build these flags, what I am doing is I am simply checking whether the current year is less than equal to the tenure of the bond or not. Okay, so here I am checking that this 1 year is less than 5 or not. So this is true, so it will give you true. And similarly here at 6, it's checking whether this year is less than equal to this tenure or not. Here it is not, so it will give you false. Now here these true false is the output of a logical statement. Okay, so true and false are binary. So here true is equivalent to 1 and false is equivalent to 0. Now if you multiply this $10 with simply true and false, so whenever you have true, that number is getting multiplied by 1, which makes it the same number, $10. And here this $10 is getting multiplied with 0, so you will get 0. Okay, hope that answers your question, Anand. Sorry, Nityanand. Okay, coming to the discount factor. So here the expectation, so if I go here, so the expectation here was this yield to maturity, correct? The expectation is yield to maturity. Now when I say discount factor, I'm referring to this complete part. That is 1 upon 1 plus YTM raised to power the corresponding year. So here for the first cash flow, what is the discount factor? That is 1. For second cash flow, that would be 1 upon 1 plus YTM raised to power 2. And for the last, it would be 1 upon 1 plus YTM raised to power T, where T is the maturity. Right? So this is the discount factor. So there is a difference between discount factor and the expectation of the discount rate. Okay. Okay, that's great. Okay, Prashant says, what is the face value? So face value is nothing but the notional value. So it is a number on which you will calculate the coupon rate. Okay, so this face value can be $100, it can be $1,000. Okay, it can be anything. So it's just a number to calculate the coupon rate. So suppose, so let me give you a perspective here. So suppose a company has to say borrow $10 million. Okay, so $10 million. So these $10 million, the company would divide into different parts. So it would build, say, 1 million such securities. Okay, so it will divide this complete $10 million into 1 million different securities, that is different papers. So now each investor can buy one paper, okay, or each investor can now lend $10 to the company. So here those $10 would be the face value broadly. So company would try to see what would be the face value or the approximate value of a security. So it's just a okay. Yeah. Right. So see, this face value is just a imaginary number, okay, on which the coupon would be decided. Okay. About the model. Okay. So here it's exactly similar. So what Prashant is saying is that how to find this 100. So here it's exactly similar to this coupon payment. So here our flag was that the coupon payments would be done whenever whenever the year is less than the tenure, and the face value is always paid at the maturity, correct? Right? The face value is always provided at the maturity. Now here I need to find a flag when this face value, this year would be equivalent to the maturity. So I just need to find the last year. So if it is 5, I need to check whether this is equal to 5 or not. So if this is equal to 5, I will get true or false, right? So it will check this 5 is equal to this tenure or not. So if it is equal, then it will give you true. True into that notional amount will give you the cash flow corresponding to it. Okay? Does that answer? Okay, cool. So any question till this point, guys? Now here I can change these assumptions. So 5 can be changed to say 10, okay, and it will give you the corresponding cash flows. First these cash flows, and then the present values, and then this price of the bond. So Excel has inbuilt functions to find the present value of these cash flows. You can use NPV function, you can use PV function. So there are a lot of functions given to you. Okay, so it's just for the illustration purpose that how to calculate the present value of each and every cash flows, and then come up with the price of the bond. All right. Now, in the beginning, I told you this relationship. James will send this Excel workbook. Guys, we'll send this Excel workbook to you. Okay, don't worry. So here, if you see this, I was talking about the relationship between C and YTM. So I said if C is greater than the YTM, the price would be greater than the notional amount, right? So now we will try to check whether this relationship holds or not. Okay. So here I built a data table, so I want to check it using Excel tools. So here I have this price, okay, and I want to see what is the price if the coupon is 2%, okay, and the interest rate is also 2%, or the yield to maturity is 2%. So whatever would be the price that I want to see here, okay, I want to see here. So I can run a data table. In the row input cell, I want to change the coupon payment, so I have taken this assumption here. And in the column input cell, I want to change the yield to maturity, which is 6%, that I have taken here. So if you see this, you will get the price here. Now here, if you see that whenever the coupon payment is equal to the yield to maturity, you always get this price equal to the notional amount. So when the coupon was 2%, the interest was 2%, your price was $100. And similarly, when coupon was 3% and the interest rate was 3%, the price is equal to $100. That is equal to the notional amount. So whenever coupon is equal to the yield to maturity, the price would be exactly equal to the notional amount. And whenever the coupon is greater than the yield to maturity, if you remember, C is at the numerator. If coupon is greater than the yield to maturity, which is the case here, 3%, and the yield to maturity is only 2%, the price of the bond would be greater than the notional amount. So if you see all these scenarios here, so here the prices are more than the notional amount, which is $100. And similarly, when coupon is 2% and the yield to maturity is greater than 2%, that is, the denominator is greater than the numerator, the prices would be less than the notional amount, which is $100. Right? So now that result you can see. So here I was having a coupon of 10% and the yield to maturity of 6%. So I was somewhere here, the coupon was 10%, right? Coupon was 10% and the yield to maturity was here, right? So I was getting this $129 as the price. So 6% and 10%, I was getting this $129, right? So this is a quick way of checking what the price would be depending on what parameter you are trying to choose. Okay, so if I want to see what is the relationship, if you want to see what is the relationship between, say, price and, say, time to maturity, then again you can run similar kind of data table or sensitivity analysis. Fine, guys, any question in this? Okay, so Shelu is asking how to build this kind of table. So let me take an example here. So here, suppose I want to see that what is the relationship of the price of the bond, okay, with respect to the time to maturity or the tenure. Okay, so here I will link it to what parameter I want to see. I want to see the price of the bond by changing the time to maturity. So starting from 1, I want to see what is the effect if the time to maturity changes from 1 to 10 years. Okay, so you will follow exactly the similar kind of structure. So here you will write all your numbers that you want to change. So in the tenure part, I want to change the numbers from 1, 2, 3, 4, and so on. And at the consecutive column and a row above it, you would link it to the parameter that you want to see. So I want to see the price of the bond. Okay. Then select this complete table and run the data table. So data table would be given in data tab, go to what if analysis, and then data table, and you will get this kind of a pop-up window. So here it will ask you for two inputs. One is row input cell and then column input cell. In the row input cell, type in the number that is available on the row side. Okay, what assumption you want to change on the row side. So here I was changing that coupon rate, but here I don't have any assumption on the row side. So I'll leave it blank, and as a column part I have tenure. So I'll link it to this tenure. Now I'll click OK. It will give me the price of the bond if the tenure is 1, 2, 3, and so on. Okay, and at the maturity, say 10 years, we know the price is $129. So Muhammad is asking whether we need to type in a formula here or just the numbers. You can input just the number as well. So here I've typed the formula, but I've converted these into values now. So I've converted these into numbers. So here what you could have done is you could have deleted this as well. Okay, 0, and say you type in some number 8 here, so it will give you the value corresponding to that number. So if 8 is the time tenure of the bond, 125 would be the price. So you can either write a formula or just type in the numbers. Fine. Does that answer your question, Mohammed? And similarly, Shalu and Nalini? Nalini, does that answer your question? So okay, so Nalini is saying, do we have to go to data and then put range? So no. So here this range is you can type in any number. So depending on what value you want to change this tenure to, you can type in that number. So I want to see what is the effect of the price if the tenure of the bond is 1, 2, 3, 4, so on. Okay, so I put those numbers. Okay, and then you link it to the price and then run the data table. So what is happening is Excel is calculating the price of the bond by changing this assumption. So for 1, it will change this to 1 and find the price. So if you see here, so if you change it to 1, what is the price? 103, or say 104. Okay, so here it will put this value 104, and if it is 2, it will put 107. It will put 3 here and then calculate the value and find the corresponding price. Okay, and so on. So this is the case here. Okay, right? So here you can type in any numbers that you want. I'm getting a lot of questions now. Okay, let me see what people are saying. Okay, so Hussein is saying, how do I make a data table if the price value is in the different sheet? So Hussein, if the price value is in the different sheet, you can simply link it here. Okay, but the only problem is, the only drawback of this data table is that whatever is the assumption. Okay, so if you are taking any assumption in the data table, so I was trying to change this tenure of the bond, correct? So this tenure of the bond assumption has to be in the same sheet. So that's the key here. So here the dependent variable can be taken from any sheet. So even if this price is calculated somewhere else in the sheet, you can take that value from there. But the idea is, okay, I'll show you with an example. So say this price that you have calculated here, that say in this sheet 1. So I've cut this, I've pasted it here. Okay, so here I'm calculating the sum of all this, right? So in sheet 1, I'm calculating this price. Now what I'll do, I will link this price. Okay, so I'll link this price here. Okay, so this is in the sheet 1 now. in a different sheet, and now I will run this data table in the similar fashion. So column input cell in the tenure. So it will work. But it will not work if I build this data table here, because the assumption that I want to change is in this sheet. So the idea is you have to build your data table in the same sheet where the assumption is. Is that fine, Hussein? Okay, great. Now, is that fine, Hussein? Okay, somebody is asking me what happens with the fluctuating interest rate. So because that's a different game altogether. So whenever you have fluctuating interest rates, so actually these numbers are not assumed to be constant, this 6%. Okay, so these are itself modeled. Okay, so that's a completely different game altogether. Okay, so maybe towards the end of the session, once I close this session, we can talk about it. Okay, Hussein, does that answer the question? Okay, Prashant, we'll see that. So now say Hussein, did you get what I've done here? So what I've done here is I've inserted another sheet, okay, and I've calculated the price now. Okay, so I've calculated the sum of this bond price in a separate sheet. Okay, so once I've calculated this, I built the data table in the similar fashion. Now I'm not linking it to the price here, but I'm linking it from another sheet, right? So now if you see here, this is sheet 1D2, it's coming from another sheet. Now I run this data table the similar fashion. The column input cell, I link it to the tenure and it will give me the price. So the idea is you can change your dependent value. You can take this dependent value, that is the price, from any sheet. But the idea is you should not have this assumption in a different sheet. So if you want to say, suppose you want to build this data in this sheet, that was not possible because the assumption that you have taken it in this sheet. So wherever your assumption is, you have to build the data tables in the same sheet. Okay. Does that answer now? Okay. Now I want to see what is the relationship of this tenure with respect to the price of the bond. So I'll make a graph here. I'll go to insert, scatter plot, and then I'll build this kind of graph. So this gives me the relationship of the bond. This gives me the relationship of the bond with respect to the time to maturity. So if the time to maturity is and similarly, if the time to maturity is 9, the price would be $127. As the time to maturity decreases, the price of the bond is also decreasing. Okay, and the notional value was $100 if you remember. It is tending towards this $100. If the time to maturity was 10 years, the price was very far away from $100, which was the notional amount. But as the time to maturity decreases, the price also comes towards this $100. Now this is not only the case with this kind of a bond, which is the premium bond. So here this bond was a premium bond. this is also the case with the discount bond. So let me change this assumption. So here the interest rate was 6% or yield to maturity was 6%. So suppose I change it to 10%. Okay, I change it to 10% and I change this coupon percent to 6%. Now again see here, when the maturity was 10 years, the price was only $75. But as the maturity decreases, this price tends towards this $100. What is the result here? Key takeaway here is that as the time to maturity decreases, the price of the bond tends towards the notional amount. Okay, and this concept is called as pull to par. So par value or the face value or the notional value was $100, and as the time to maturity decreases, all the bond prices tends towards the notional amount. So that's the key takeaway. So that concept is called as pull to par. Okay. Fine. So as an Excel exercise, what I want to do here is say I want to build, say, for discount bonds, okay, and for premium bonds. Okay, so here I want to build, say, some kind of option, okay, and so that I could choose from premium bonds and discount bonds. I want to choose it from discount bond or premium bonds. Okay, so whenever I have a discount bond, so I want to write a condition here. Say if this is equal to 1, if this is equal to 1, I have a discount bond, and whenever I have a discount bonds, the coupon is say 6%, and whenever I have a premium bond, the coupon is say 10%. Okay, and exactly opposite is the case here. So whenever I have a coupon, I would have, whenever I have a discount bond, this would be 10%, and whenever I have a premium bond, this is 6%. So here, if you remember, I was having a premium bond, right? So the coupon was 10% and the interest rate was 6%. Now if I change this to discount bond, these assumptions will get flipped and you will get this premium bond. Now if you want to see both the prices, you can see both the prices in a separate sheet, right? So here the key takeaway is that as the maturity of the bond decreases, the prices of the bonds will tend towards the par value. Okay, so here the key aspects of this session would be that how to find the price, that is one, how to find the price of the bond. So here, to find the price of the bond, which means the value of the bond, we need to keep in mind 3 important things, and those 3 important things are cash, expectation of the investor, and the third one is the time frame. So first we need to find what is the cash to the investor. Once we get that, we need to figure out what is the expectation of the investor, which is given by the yield to maturity, and then finding the present value using this yield to maturity, we will get the price of the bond. Correct? The next was, what is the relationship of the price of the bond with respect to the coupon payments, or the yield to maturity, or the tenure of the bond. So we have seen that if the coupon payment increases, the price of the bond would increase. So if you see here, the coupon payment is increasing from 2% to 3%, the price is increasing from 100 to 103, and so on, right? And we have also seen that if the yield to maturity or the interest rate in the market increases, the price of the bond would decrease. So here if you see, From 5% to 6%, the price has gone down from 92 to 89. That was another relationship. Also, we have seen what kind of bond exists. So there are three kind of bonds. One would be premium bonds, where the coupon payment is greater than the yield to maturity. This is the case here. The second is the discount bonds, where the yield to maturity is greater than the coupon payment. And the third one is par bonds, where coupon payments are equivalent to the yield to maturity, right? And in the last part, we have seen what is the effect of the tenure of the bond on the price of the bond. So no matter what kind of bond it is, if the tenure of the bond decreases, the prices of the bond tends toward the face value of the bond or the notional value. Okay, so these are the three key concepts. So if you have understood these three concepts, I think the session has been successful. So any question on these aspects? Okay. Okay, Vikas is asking about Deepak, we have your email IDs, I suppose. I think we would be able to send this Excel file with solution. Okay. So yes, Mustafa, you can use PV and NPV functions as well. So as I mentioned in the session, you can use PV and NPV functions both. Okay, so how to build this kind of drop-down box? So this is called as combo box. So you can go to developer tab if you don't have a developer tab, and depending on what Excel you're using. So if I'm using Excel 2007, you will see you have to click on the ribbon, go to Excel options, and in Excel options go to general, and you will see three options there. One option would be check developer tab, so you need to check that option. If you're using Excel 2010, go to options here, go to customize ribbon, and here you will see this developer tab. So if you check that, you will see this developer tab here. Okay, so once you get this developer tab, go to insert, you will see these form controls, select a form control here, click on this and make a form control. And then every form control will have two parts. One would be input and the other one would be output. Right click on that form control, go to format control, and select the input range, what you want to see in the list, and cell link it to a particular cell. Now here the input would be this discount and the output would be this value. So what's the meaning of this one? The meaning of this one is that what is the relative position of the value selected. So here I have selected this discount from this array. So discount is at the first position in this array, so it is giving you 1. So if I select premium, it will give you 2. Got it, Vikas? Okay, great. So any other question, guys? So, okay, cool. So if there are no other, okay. Yeah, Prashant, you can get it in Excel 2007. Okay. So you can search on Google, you will get. Okay, guys. If no further questions, let us end this session, and we will send you this Excel workbook to all the email IDs. Yes, Manish, you can get that. So we have recorded this session, and you can also take a look at the recording. So if you haven't got some part of this complete session, you came late, you can download this recording. So we'll send you the link. Praveen, no. Okay, guys, I think I should end this session now. Okay. Okay, guys, bye-bye. Ending this session now. Bye.
The organizer has ended the session, and this call will be disconnected. Goodbye.